Investors are calling for the Federal Reserve to cut interest rates at its next meeting in September. Nearly 50% of traders anticipate a 50 basis point cut, while the other half see a cut of just about 25 basis points. But what could all of this mean for your checking and savings accounts? Here with some answers is our very own Kerry Hannon. Kerry, what should consumers be aware of heading into that critical September meeting?
Yeah, absolutely. Here's the thing. It's going to, if you have adjustable rate, interest rate on your credit cards or your mortgage, these things are going to be impacted if they cut rates. Now, what happens is, the important thing to do right now, if you anticipate this rate cut, is to lock in some good rates right now. I mean, you could lock into a 9-month or a 1-year CD. Online savings accounts are still, and CDs and money markets they're paying around 5% now, which is really quite nice and well above inflation. So I would suggest that's something they should consider, because these will tick down as the rate cut comes upon us. Now, this is just personal opinion, but banks tend to anticipate a lower rate, so they may get at this earlier than September to start trimming back some of their interest rates, and they're slower to raise them back up when the rates are up. So just keep that in mind. If you're a retiree, though, or near retirement, you might not want to lock in for quite that long if you think you're going to need that cash for living expenses. So be wary of that, because if you're in a 1-year CD and you actually need the money, you're going to pay a penalty to take it out.
And Kerry, just to follow up there, what could lower rates mean for borrowers?
Yeah, that's a real sweet spot, because it can very much lower your monthly bills, right? Particularly on credit cards, right? So, what happens, it has a very direct impact. And what happens is your annual percentage rate, the yield, the rate that the credit card companies are going to charge you, they use that prime rate as a starting point to determine what your interest rate is going to be. So if it drops down, it's going to drop down. And so that APR is that. Plus, they generally go maybe 3 points above that to set the rate, and then they determine how your credit score, how that plays into it. So there's some wiggle room on what your rate will be, but you can anticipate those will dip down somewhat. It's not going to be huge, but it will drop down, but don't expect it to happen overnight. They don't react as quickly as the banks do. So your credit card interest rate, for it to dip down, it usually takes 2 billing cycles, or roughly 2 months, before it actually, you'll see that number drop down in your account. So I encourage people to keep an eye on that, because that's a very positive thing. And finally, if you have a big purchase you're looking at ahead of you, maybe it's a car, maybe it is a house. We already see mortgage rates ticking down now. You might hold off a little bit just to see if this goes through in September if you can.
All important things to keep in mind. Kerry Hannon, thank you so much.
Thanks.